though. China's ambassador to Canada says China will drop its tariffs on agriculture if Canada drops its EV tariffs on China. How should Canada respond?
A sealed note lands on a desk in Ottawa. A message from Beijing offering what insiders are calling a golden deal. The terms are shockingly simple. Remove the 100% tariff on Chinese EVs, and China will lift every tariff on Canadian agriculture, from canola oil to pork and seafood. In a single stroke, nearly $5 billion in frozen exports could be unlocked within weeks. On paper, it looks transactional. In reality, it's a stress test of Canada's economic sovereignty, a quiet challenge to North America's trade front, and a move that could redraw global supply chains at the expense of the United States. Why does this matter to an American audience? Because the fallout won't stop at the Prairies. If Canada takes the offer, U.S. farmers, already watching Brazil seize roughly 75% of China's soybean market, could see the world's second-largest buyer rewire its food security with Canadian crops. If Ottawa refuses, Western Canada's rural economies face deeper pain. Silos overflowing, processing plants underutilized, and credit tightening across Saskatchewan, Manitoba, and Alberta. Either way, the decision exposes a continental fault line: EV manufacturing and auto jobs in Ontario versus farm incomes on the Prairies, Washington's protectionism versus Beijing's leverage, loyalty versus autonomy. This episode follows the mechanism, not the noise. We'll track how a single tariff swap can flip bargaining power in the USMCA era, why China's proposal is less a gift than soft leverage, how the US, amid zero new Chinese soybean orders, lost market share, and rising producer stress, is losing the narrative in its largest agricultural market, and what it would mean for American prices, jobs, and regional politics if Canada moves toward a dual-lane trade model spanning both Washington and Beijing. The question isn't just, will Ottawa say yes? It's, what does a middle power do when two superpowers weaponize its prosperity? Because when food security, clean tech, and alliance politics collide, the winner isn't the loudest. It's the one that controls the bottlenecks and timelines. To understand the weight of this golden deal, we need to trace the path that brought Canada here. A story of loyalty, leverage, and unintended consequences. It began in 2024, when Washington reignited its trade war with Beijing, framing it as a fight for industrial survival. Under Trump's new tariff regime, the U.S. slapped 100% import duties on Chinese electric vehicles, citing unfair subsidies and national security risks. Behind closed doors, American trade officials demanded that Canada follow suit, arguing that if Chinese EVs entered through Vancouver or Montreal, they'd eventually flood the U.S. market through backdoor channels. Caught between politics and pragmatism, Ottawa complied. Canada imposed its own 100% tariff on Chinese EVs, not because it wanted to, but because it didn't want to be the outlier in North America's united front. On paper, it looked like solidarity. In practice, it was surrender. There was no reciprocal reward from Washington. No guarantees, no exemptions, no trade offsets. Instead, Canada found itself punished twice. Beijing retaliated, slapping punitive tariffs on Canadian canola, pork, and seafood, the lifeblood of the Prairie provinces. The effect was immediate and brutal. Canola exports to China collapsed by nearly 76%, dropping from billions to just $96 million by August 2025. Pork shipments fell by 25%, costing Manitoba farmers over $19 million in annual losses. And in towns like Regina, Moose Jaw, and Brandon, storage silos filled with unsold grain, credit unions tightened loans, and entire supply chains began to stall. Meanwhile, the U.S., the very ally Ottawa mirrored, fared no better. China, once the largest buyer of American soybeans, stopped buying entirely. Imports that once totaled $12.6 billion USD vanished. Brazil stepped in to dominate, taking 3/4 of China's soybean market and leaving U.S. farmers stranded. By mid-2025, Washington's agricultural heartland was bleeding nearly $9.4 billion a year in lost export revenue. The irony was painful. The two nations that had tried to corner China were now undercutting themselves, while Beijing calmly rewrote its supply routes, funneling food from Brazil, Australia, and now possibly Canada. That's the backdrop to this moment. The Golden Deal didn't emerge from goodwill. It emerged from strategy. China saw the cracks in the Western alliance, the strain between Ottawa's loyalty to Washington and its dependence on Beijing's markets, and moved precisely where North America was weakest. But this wasn't just about agriculture. It was about identity. Canada's economy has always walked a tightrope between resource exports and manufacturing, between the prairie farmers and the Ontario auto workers. Beijing's offer hits right at the center of that divide, forcing Canada to choose who it really is: a satellite economy in the U.S. orbit, or an independent player in a multipolar world. And the choice isn't theoretical anymore. It's sitting in the Prime Minister's inbox, stamped urgent. Because what Ottawa decides next won't just determine where its canola goes, it will determine where Canada belongs in the global order that's taking shape right now. The so-called Golden Deal sent ripples far beyond the walls of Ottawa. What seemed like a regional trade dilemma quickly escalated into a continental fault line, one that stretched from Beijing to Washington, shaking confidence in North America's unity and exposing just how fragile the post-pandemic trade order had become. China's move. Precision diplomacy. In Beijing, the offer was crafted with surgical intent. It wasn't just about reopening a $5 billion agriculture pipeline. It was about testing the limits of U.S. influence. By dangling access to China's enormous food market, the world's second-largest economy was applying what economists call soft leverage. No threats, no sanctions, just temptation. The calculus was simple. If Canada accepted, it would break ranks with Washington, signaling that even America's closest ally was willing to act independently. If Canada refused, Beijing would tighten its restrictions and deepen its relationships with Brazil and Southeast Asia, further isolating North American exports. For China, it was a win-win. For the West, it was a wedge. America's disbelief. Inside Washington, the proposal triggered alarm. Trade officials and congressional aides privately admitted what they wouldn't say on camera. The United States could no longer control global food supply routes the way it once did. While Chinese buyers shifted to Brazilian soybeans and Argentinian corn, American farmers were watching empty silos pile up across the Midwest. At the same time, U.S. automakers were lobbying fiercely to keep Canada in lockstep on EV tariffs. Their fear was obvious. If Ottawa opened the door to Chinese electric cars, it would create a backdoor into the North American market, allowing lower-cost Chinese models to enter through Canada and eventually reach American consumers. The debate inside the White House wasn't about trade alone. It was about credibility. Could Washington still claim to lead the free trade world if one of its closest partners broke ranks? Would other allies follow suit? Canada's balancing act. In Ottawa, the tension was palpable. Doug Ford, Ontario's premier, warned that lifting the EV tariffs could wipe out tens of thousands of jobs in his province's auto corridor. But in the Prairies, premiers from Saskatchewan, Manitoba, and Alberta saw the deal as salvation, a way to save farmers crushed under the weight of lost exports. The split wasn't partisan, it was geographic. The industrial East wanted to protect factories. The agricultural West wanted to reopen fields. For the first time in decades, Canada's economic map looked divided between two competing visions of the nation's future. One tied to Washington's supply chains, the other drawn toward Beijing's markets. Markets and allies react. Global investors watched carefully. The Canadian dollar edged higher on speculation that renewed Chinese trade could inject billions into the commodity sector. Meanwhile, European analysts quietly praised Ottawa's restraint, calling Canada a potential bridge economy between East and West, stable enough to trade with both blocs, neutral enough to stay out of their wars. Even Brazil, now the dominant supplier to China's soybean market, saw risk. If Canada entered the game again, Beijing could use competition between exporters to push global food prices down, another strategic victory for China's inflation control. The bigger shift, a new axis of trade. Beyond the headlines, the situation revealed a deeper transformation. The age of unipolar trade, where the U.S. set the rules and everyone followed, was fading. China no longer needed to confront Washington with tariffs or military posturing. It could rearrange global demand with a single trade offer. And Canada, a middle power long defined by loyalty, was suddenly the pivot point of an entire geopolitical balance. The shockwaves were clear. The U.S. risked losing its grip on North American trade coherence. China was rewriting the rules through charm instead of coercion. And Canada found itself holding a golden key, but not knowing which door it truly opened. Because if Ottawa turned it, the lock it might pick wasn't just economic. It could unlock the next era of global alignment, where loyalty costs more than independence, and silence becomes a form of strategy. For Washington, the Golden Deal wasn't just a headline, it was a warning shot, not from China, but from its own backyard. For decades, the United States assumed that economic alignment across North America was unshakable, that if Washington moved, Ottawa and Mexico City would follow. But Beijing's proposal to Canada shattered that illusion, showing that loyalty could be outbid by opportunity. The U.S. loses its leverage. The most immediate impact landed where it hurt most: America's farmers. China's agricultural import pivot, once temporary, became permanent. By the end of 2025, Chinese orders for American soybeans had collapsed to zero. The U.S. Department of Agriculture estimated $9.4 billion in annual losses for Midwestern producers, a figure large enough to wipe out entire rural economies. Farmers who had spent years lobbying for stability were now facing the same reality that Canadian farmers had endured a year earlier, a trade war without end and without payoff. Meanwhile, Brazil, aided by Chinese investment in logistics and ports, captured nearly three-quarters of China's soybean trade, locking in supply routes that may never revert to the U.S. For a White House built on promises to restore American dominance, it was the most damaging economic optics imaginable. China gaining partners, the U.S. losing markets. The Midwest squeeze. In Iowa, Illinois, and Indiana, the shock was brutal. Grain silos overflowed, credit lines shrank. Fertilizer and fuel costs rose while export contracts vanished. Local banks that had underwritten future harvests on the assumption of Chinese demand began calling in loans. Farm bankruptcies rose 30% year over year, and rural approval ratings for Washington's trade policies plummeted. Even Republican governors, traditionally loyal to Trump's economic agenda, began publicly questioning whether the tariffs were sustainable. One farmer, quoted by the Des Moines Register, put it bluntly, "We were told this was a war to win. It's starting to feel like a war we're fighting alone." Industrial turbulence. The crisis didn't stop at agriculture. By cutting off Chinese imports of critical minerals and EV components, the tariff regime drove production costs for American automakers through the roof. Factories in Michigan and Ohio reported component delays and higher material prices, just as inflation had begun to cool. Ironically, while Washington claimed it was protecting Made in America, Chinese EV companies quietly started exploring Canadian assembly partnerships, giving them access to the North American market under USMCA, but outside U.S. jurisdiction. In other words, the tariffs designed to isolate China could actually create a Chinese manufacturing bridge inside Canada, right above the American border. Diplomatic discomfort. Inside the Beltway, frustration turned to panic. State Department officials warned that if Ottawa accepted Beijing's offer, it would undermine the credibility of USMCA, the very trade pact that symbolized North American unity. At closed-door meetings, U.S. negotiators began floating the possibility of retaliating against Canada, not through tariffs, but through regulatory friction, lengthier border inspections, certification delays, and revised safety standards for cross-border goods. But such measures risked backfiring. Any open pressure campaign would only confirm what Beijing was trying to prove, that the U.S. was bullying its allies to preserve a crumbling trade order. Wall Street's verdict. Markets read the situation faster than politicians. Commodities traders began pricing in long-term Canadian export growth. The Canadian dollar gained modestly, reflecting renewed investor confidence in its resource base. Meanwhile, U.S. agri-stocks fell across the board, and EV sector shares wobbled as investors braced for Chinese market access through Canada. Bloomberg analysts summarized it in one line. Washington may have started the tariff war, but Beijing and Ottawa are now rewriting its rules. The broader implication. For the first time in modern history, America's economic vulnerability wasn't being exploited by a rival, but by its own strategy. Tariffs meant to isolate China were isolating the United States itself. And as Beijing played long-term chess, Washington looked trapped in a short-term cycle of escalation and retreat. The U.S. still has leverage, its market size, its currency, its defense umbrella. But the psychological advantage, the confidence that allies would never look elsewhere, has cracked. Because when a nation like Canada, built in America's shadow, starts weighing independence over allegiance, it's no longer just trade policy. It's the beginning of a post-American economic order. Every major trade realignment produces its own scoreboard. And in the wake of China's Golden Deal and the U.S. tariff war fallout, that scoreboard shows a quiet inversion of power, where the smallest players in the global economy learn to move faster than the giants that built it. Winner: China, the architect of soft power. China didn't win this round with force. It won with timing. While the U.S. used tariffs to punish, China used trade to tempt. By offering Canada a straightforward economic lifeline, remove your EV tariffs and we'll reopen our markets to your farmers. Beijing flipped the traditional playbook. It exposed how the West's obsession with punishment had left it politically and economically exhausted. Beijing's move achieved three objectives at once. Fractured North America's unity by forcing Ottawa to choose between Washington and its own prosperity. Expanded its influence without violating any global trade law. Rebranded itself, not as a threat, but as a partner of opportunity for nations caught between blocks. This is economic statecraft at its most refined. Beijing didn't break Canada, it made Washington look like the one holding it back. Winner: Canada's Western heartland. After years of silence and stalled exports, the Prairies, once forgotten in Ottawa's global trade debates, suddenly hold the keys to the national economy. If Canada accepts the deal, Saskatchewan, Alberta, and Manitoba could see billions flow back into their agricultural sectors within months. Even the mere possibility of renewed Chinese demand has sent a wave of optimism through the farming industry. Grain processors are preparing for rapid scale-ups. Local shipping hubs are reopening dormant rail lines, and agricultural lenders are already drafting new loan terms anticipating higher revenues. For these provinces, the Golden Deal isn't about geopolitics, it's about survival. And this time, the farmers may have more leverage than the politicians. Winner: Brazil and Global South exporters. While Canada debates and America hesitates, Brazil continues to thrive. China's long-term contracts with South American suppliers are reshaping global food flows. And even if Canada rejoins the market, Beijing now holds all the negotiating cards. Brazilian exports are up 60% year over year, and its ports, rebuilt with Chinese financing, have become the new arteries of global agriculture. What used to be America's breadbasket advantage is now shared between two hemispheres. Brazil, the supplier of soybeans. Canada, the supplier of canola and protein crops. Together, they form the backbone of China's food security, while the U.S. watches from the sidelines. Loser: the U.S. Farm Belt. Few regions have suffered more than America's Midwest. With Chinese contracts gone and tariffs still in place, U.S. farmers face a dual squeeze. Low prices at home, no markets abroad. Federal subsidies have ballooned to keep farms afloat, But even that lifeline can't last forever. In towns across Iowa, Kansas, and Nebraska, resentment is growing. Not against China, but against Washington's stubborn insistence on winning a trade war that seems to only punish its own base. As one farmer told Reuters, "They're calling it strategy. We're calling it survival." If Canada re-enters the Chinese market, the symbolic loss for American agriculture will be enormous. It will confirm that the U.S. no longer controls the world's food chain. Loser: Ontario's auto industry. The flip side of the Golden Deal lands hard in Ontario. For Premier Doug Ford, lifting EV tariffs means opening the floodgates to Chinese electric vehicles that undercut local automakers by 30 to 40%. Ontario's factories, tied to U.S. production networks, risk losing tens of thousands of jobs if cheap Chinese EVs gain traction in the North American market. While prairie farmers see opportunity, auto workers see existential threat. The result? A political schism within Canada itself. A fight not between parties, but between regions and industries. Loser: the U.S. itself. More than any country, the United States walks away from this chapter isolated. By turning trade into a weapon, it drove both allies and rivals to look elsewhere for stability. By insisting on loyalty, it pushed Canada, its closest neighbor, to consider independence. The Golden Deal might never have existed if Washington had offered partnership instead of pressure. But now, the damage is done. A generation of Canadian policymakers is learning that economic survival may no longer depend on American approval. The unexpected reality. The scorecard is clear. China gains influence. Canada's farmers regain hope. The U.S. loses control. North America loses coherence. This isn't just a redistribution of wealth, it's a rebalancing of power. The West's greatest weakness was never China's rise. It was its own assumption that allies don't have options. Now, Canada does. And that might be the most dangerous precedent of all. The Golden Deal is no longer just a diplomatic rumor. It's a decision point that could reshape North America's trade architecture for the next 2 decades. Canada now stands between two futures, one that reinforces Washington's economic orbit, and another that redraws it entirely. Here are the 3 scenarios that economists and policymakers are quietly modeling behind the scenes. Scenario 1. The Golden Gamble. Canada accepts the deal. Ottawa lifts the 100% tariff on Chinese electric vehicles, betting that the domestic auto sector can survive limited competition in exchange for unlocking $5 billion in agricultural exports. What happens next? China immediately drops its tariffs on canola, pork, and seafood, triggering a surge of exports from the Prairie provinces. Saskatchewan's canola fields return to full production. Port terminals in Vancouver and Prince Rupert reopen idle shipping lanes. The Canadian dollar strengthens, rural economies rebound, and Canada's GDP ticks upward. But geopolitically, the aftershocks begin immediately. Washington retaliates quietly, tightening customs inspections, delaying approvals for Canadian components, and introducing non-tariff barriers disguised as safety or origin rules. Behind closed doors, U.S. automakers warn that Canadian EV imports are being used as a backdoor for Chinese industry. The White House labels Canada's decision deeply disappointing, while Beijing celebrates it as proof that North America's independence is maturing. The outcome: Canada gains short-term prosperity but risks long-term friction with its largest trading partner. China secures both agricultural imports and symbolic victory, demonstrating that it can fracture Western unity without firing a shot. This is the bold path. Economically tempting, geopolitically explosive. Scenario 2. The loyal line. Canada rejects the deal. Ottawa stays aligned with Washington, keeping the EV tariffs intact. It's the safer move politically, but the cost is brutal. The fallout. China cuts off remaining canola imports completely. Western Canada's export economy collapses further, triggering mass layoffs and emergency subsidies. Discontent spreads across the prairies, where farmers begin calling the trade policy Ottawa's betrayal. To calm the anger, the federal government increases domestic aid, but that spending only deepens the deficit. At the same time, Ontario's manufacturing base remains protected, preserving auto sector jobs and keeping U.S. investors satisfied. From Washington's perspective, it's a success. Canada stayed loyal. But from Beijing's perspective, it's a missed opportunity, and Canada is quietly downgraded in China's long-term trade strategy. The outcome: Canada avoids U.S. retaliation but pays for loyalty with stagnation. The Prairies become a symbol of collateral damage in someone else's trade war. This is the safe path, politically stable, economically suffocating. Scenario 3. The middle path. Canada balances both sides. In this hybrid model, Canada begins gradual normalization with Beijing, starting with limited agricultural access and research collaboration, without fully removing the EV tariffs. It's a pragmatic compromise that buys time and tests reactions. What unfolds? China responds positively but keeps pressure on, using phased incentives. The U.S. watches warily but stops short of retaliation, preferring quiet negotiation over open confrontation. Canada introduces the concept of a dual-lane trade model, one lane for North America, USMCA, another for the Pacific, Asia. If successful, Canada could evolve into a strategic bridge economy, trading freely with both East and West, becoming a global logistics and innovation hub rather than a satellite of either power. The outcome: Canada regains leverage. China gains partial access. The U.S. realizes it can no longer dictate Canada's choices unilaterally. This is the most likely path: subtle, slow, and deeply strategic. Signals to watch. Over the next year, a few developments will reveal which direction Ottawa is taking. Tariff language softening in official documents or ministerial statements. New agricultural export permits or trial shipments to China. Joint Canada-China business delegations appearing at trade expos. A sudden increase in U.S. customs scrutiny. Washington's silent form of retaliation. If all four appear in quick succession, the Golden Deal is already in motion, just not in public. The future map of power. No matter which scenario unfolds, one truth is clear. The era of automatic alignment with Washington is ending. Ottawa may still be a U.S. ally in defense and security, but in trade, the gravitational pull of Asia's markets is becoming irresistible. If Canada manages to navigate between the two giants, to trade with China without betraying America, it could emerge as a new model of middle power independence. If it fails, it risks becoming the first casualty of the post-globalization era. Because the Golden Deal isn't really about tariffs, it's about testing whether a country can stay loyal to one superpower without becoming blind to the other. The Golden Deal has become more than a trade proposal. It's a mirror, reflecting the uncomfortable truth that Canada's fate and perhaps North America's balance now hinges on a single question: can loyalty and independence coexist in the same economy? What began as a quiet offer from Beijing has evolved into a moment of reckoning for Ottawa, Washington, and beyond. A lesson in leverage. China understood something Washington forgot. The world's new currency isn't dominance, it's flexibility. Where the United States built walls, China offered access. Where Washington demanded loyalty, Beijing proposed opportunity. And in that difference lies the real contest of the 21st century. Not between armies or ideologies, but between rigid power and adaptive influence. For China, the Golden Deal was never just about canola or cars. It was about showing the world that even America's closest allies now have choices. For the United States, it was a reminder that tariffs and threats can't replace trust. And for Canada, it became the clearest sign yet that middle powers are no longer spectators. They are the swing votes of globalization. The domestic divide. Inside Canada, the fault lines are unmistakable. The East, powered by manufacturing and proximity to Washington, fears the political cost of defying its southern neighbor. The West, driven by agriculture and survival, is running out of patience for economic alignment that only benefits someone else. In between them stands Mark Carney, torn between two visions of his nation's future, one loyal to the US-led trade order, the other cautiously exploring a dual-lane model open to Asia without abandoning the West. That's not betrayal, it's evolution. Because in the new global economy, where every decision carries geopolitical weight, the greatest act of independence may be the willingness to say yes to both sides and no to being cornered by either. The U.S. dilemma. For Washington, the shock isn't that China made the offer, it's that Canada is even considering it. For decades, the U.S. defined the rules of the Western world, who traded with whom and on what terms. But, as one American economist told Bloomberg, if even Ottawa can afford to question U.S. leadership, it means the post-war order isn't eroding. It's already gone. The United States remains powerful, but power without adaptability is inertia. And in a world where Beijing offers deals while Washington delivers demands, inertia can be fatal. The broader message. What's unfolding isn't just a Canadian story, it's a blueprint for the post-American trade era. Every middle power, from Australia to South Korea to the EU, is now learning to balance alliances like investments, diversified, cautious, and transactional. The idea of permanent sides is dying. Interest is the new ideology. If Canada accepts the deal, it could quietly pioneer a new diplomatic model, one that prizes resilience over obedience. If it refuses, it remains safe but stagnant, preserving loyalty at the cost of leverage. Either way, the outcome will signal to the rest of the world how far the U.S. still commands, or how fast that command is slipping. Final thought. Golden deals don't come often, and they never come without strings. But the real story isn't about China's offer or America's anger. It's about whether a middle nation like Canada can step out of the shadow of superpowers without being crushed by them. The next time Ottawa makes a trade decision, it won't just be deciding between markets. It will be choosing the shape of its future. And perhaps the new definition of sovereignty in an age where every handshake carries the weight of history. Because in this century, independence won't be declared. It will be negotiated.